Hello, and welcome to Doing Business As, the small business law podcast from Tracktown Law. My name is Jared Hight, and I am the founder of Tracktown Law and your host for today's episode. At Tracktown Law, I help Oregon and Idaho business owners build legally sound companies without the fluff, jargon, or fine print confusion. Whether you're starting your first LLC or restructuring after years of growth, my goal is to bring clarity to the decisions that matter and keep your business moving forward. Before we get started today, a quick disclaimer. I'm a licensed attorney in Oregon and Idaho, but listening to this podcast doesn't create an attorney-client relationship, and nothing in this episode should be taken as legal advice for your specific situation. So, today's episode tackles one of the most common issues I hear from small business owners, especially those forming an LLC. Should I be an S-Corp instead? Or sometimes, I already have an LLC, should I switch to an S-Corp? And here's the thing. If you're asking that, you're not alone. The confusion around S-Corps is widespread. Part of the problem is the name itself. An S-Corporation isn't a different kind of company, it's a tax election. The S refers to Subchapter S of the Internal Revenue Code. So when someone says, I formed an S-Corp, what they probably mean is they formed a corporation or an LLC and then elected to be taxed under Subchapter S. That distinction alone trips up a lot of business owners because the structure and the taxation are two different layers and they're easily confused. Let's say you're an Oregon freelance photographer. You formed an LLC and assumed you were all set. But then a CPA friend tells you you're leaving money on the table by not being an S-Corp. Suddenly, you're wondering whether you need to dissolve your LLC and start over. Or you're worried that your taxes will be audited if you don't make the switch. Or maybe someone told you S-Corps are better for avoiding self-employment tax, but you're not sure how or if it even applies to you. That's the confusion I want to clear up today. Let's start with the basics. You have a legal entity. That's your LLC, your corporation, or your partnership. That's what determines things like personal liability, company governance, and ownership rights. Then, separately, you have how that entity is taxed. For federal income tax purposes, that's where the IRS steps in. If you're a single-member LLC, the IRS treats you by default as a disregarded entity, which means all the income flows through to your personal return as if the LLC didn't exist. A multi-member LLC is treated by default as a partnership. A corporation is treated by default as a C-Corp, but in each of those cases, you can elect to be taxed as an S-Corp instead, if you qualify. So what does that mean? An S-Corp is what's called a pass-through entity. Like an LLC, the income passes through to your personal tax return, and the business itself doesn't generally pay federal income tax. But here's where it gets interesting. Unlike a sole proprietorship or partnership, an S-Corp separates your compensation into two parts. One part is your salary, which is subject to employment tax. The other part are profit distributions, which are not. And that's where the potential tax savings come from. Let's take an example. Imagine you run a solo marketing agency in Idaho and you net about $120,000 a year. If you're taxed as a sole proprietor, the default for single-member LLC, all of that is subject to self-employment tax, Social Security, and Medicare, about 15.3%. That's roughly $18,000 in self-employment taxes before you even get to income tax. Now let's say you elect S-Corp status. The IRS requires you to pay yourself a reasonable salary. We'll say $70,000 for the work you perform. That $70,000 is subject to employment taxes, but the remaining $50,000, your profit distribution, isn't. That could save you around $7,500 in payroll taxes. Sounds great, right? It can be, but there are catches. First, reasonable compensation is a gray area. You can't just set your salary at $20,000 and call the rest tax-free. The IRS scrutinizes S-Corps that try to game the system with artificially low salaries. You need to base your pay on market value for your role, experience, industry, and duties. Second, running an S-Corp means running payroll. You need to file W-2s, quarterly employment tax returns, and probably use a payroll service. You'll also need to file a separate business tax return, Form 1120-S, and issue K-1s for each shareholder. That adds cost and complexity. Third, not all LLCs or corporations can elect S-Corp status. There are restrictions. You can't have more than 100 shareholders. You can't have non-resident aliens as owners, and you can only have one class of stock. For some startups and investor-backed companies, that's a deal breaker. So let's come back to the question. Should your LLC be taxed as an S-Corp? Here's how I usually walk through it with clients in Oregon or Idaho. If your net business income is below about $40,000 a year, the tax savings from S-Corp status are usually too small to justify the extra costs and paperwork. You're better off staying a sole proprietorship or partnership. If you're making between $60,000 and $150,000 and you're actively involved in the business, it's worth running the numbers. In many cases, an S-Corp election will save you several $1,000s a year in payroll taxes, but only if you're willing to handle the administrative side or pay a professional to do it. If you're earning over $150,000 and don't have complex ownership issues, it's likely worth the switch. But that's also the point where coordination with your CPA and legal advisor becomes critical. You want to make sure your salary is defensible, your distributions are clean, and your corporate formalities are in order. There's one more twist, the election deadline. To be taxed as an S-Corp for the full year, you need to file IRS Form 2553 within 2 months and 15 days of the start of the year, or within that same window after forming the business. You can request late election relief, but it's not automatic. So what about Oregon and Idaho state taxes? Both states recognize the federal S-Corp election, which means you won't be double taxed at the state level like you would under a C-Corp structure, but there are still differences to be aware of. Oregon has a minimum corporate activity tax, CAT, that can apply if your gross receipts exceed $1 million. Regardless of whether you're an S-Corp or not, that's separate from income tax and can surprise business owners who grow quickly. Idaho, on the other hand, tends to be a little more straightforward for S-Corp filers, but still requires a state income tax return for the entity and withholdings for any non-resident shareholders. Let me wrap with a real-world example. A Portland-based design firm formed an LLC and had no idea about tax elections. 2 years in, they were earning over $200,000 a year, but still reporting all their income as self-employed. Once they switched to an S-Corp structure, they saved nearly $12,000 in employment taxes, but they also had to clean up bookkeeping, back pay themselves a reasonable salary, and adjust their accounting methods. It wasn't painless, but it paid off. That's the key takeaway. The S-Corp isn't a magic fix, it's a tool. Used correctly, it can save you real money. Used poorly or too early, it just adds complexity without any benefit. So, if you want to know whether an S-Corp election makes sense for your Oregon or Idaho business, talk to a professional who can weigh your full picture: income, growth goals, compliance burden, and risk tolerance. At Tracktown Law, I help small business owners not just file the right forms, but understand what they're signing up for. Whether you're forming your first LLC or adjusting how you're taxed, it's about finding the path that fits your actual business, not someone else's online checklist. If you want to dig deeper in today's topic, you can check out the companion blog post for this episode at tracktownlaw.com. It's a great place to refresh or share what you've learned with others. In our next episode, we're covering something a lot of partnerships get wrong: buy-sell agreements. What they are, why they matter, and how they keep your business intact when life throws a curveball. Thanks for listening.